So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and today I'm joined by Dan Hanford. Dan and his wife, Dennae, along with their 4 children, 3 girls and a boy, and standard poodle, reside and work in Columbia, South Carolina. He's one of the managing partners at PassiveInvesting.com, which is a national passive real estate investing firm based in the Carolinas. He has led his real estate syndication company to acquire 4,200 plus units with a portfolio valued over $929 million, with just under 1,750 investors active in those assets. Dan and his wife are also passive investors in 57 different passive real estate syndications, which comprise over 10,900 doors located in the Carolinas, Georgia, Tennessee, Texas, Florida, and Idaho, with 17 different operators. Dan, welcome to the show.
Thanks, Jonathan. Appreciate you having me.
Absolutely. That's quite an extensive resume you have. So I'm really looking forward to picking your brain, and I know the listeners will enjoy your expertise as well. So let's kind of start at the very beginning. What kind of led you into this area?
So I'm actually a chiropractor by trade. And one of the things that I did when I first got out of school is I decided to start my very first practice out on my own. So a lot of chiropractors go out and they'll associate or do an internship, if you will, with another group. And I had already worked prior to going into chiropractic school with a chiropractor, actually my wife's uncle. And he taught me, and I was able to learn a lot of the different nuances to the kind of business side of the clinics. And so once I got the clinical aspect, I had the clinical and the business together, started my own practice. And then what I found out early on in my career as a chiropractor is that I was really, even though I owned my own clinic, I was still in a job because I could only see so many patients an hour. So my income was capped. And whenever I wanted to go on vacation, I had to still pay my employees my overhead. And so it cost me a lot of money to go on vacation because I'm not the one sitting there doing the adjustments and seeing patients. And so what I did is I started to hire on some associate chiropractors, and then also started to bring on some medical doctors to work for us. We had an integrated clinic. And then probably about 5 or 6 years ago now, I actually completely removed myself from doing any treatments and really solely focused on the medical component of the procedures that we were able to do, because I can now step back and be kind of in the CEO role and the business owner role and have the technicians with the different providers seeing the patients. And I didn't have to be able to be in there doing the day-to-day work. And so when I did that, I grew from 1 clinic to 4 clinics. We still have those clinics today. We have about a little over 40 full-time people that work for us in those 4 clinics. And we have one located here in Columbia, South Carolina, one in Greenville, South Carolina, Charleston, and North Augusta, South Carolina. And because of the growth that we had experienced, we were able to grow all of those and grow them debt-free. So there was no debt on the clinics. And even to this day, there's no debt, and they cash flow very nicely. But the problem we were experiencing was that we were working all the time and making a good income, but we were writing a large 6-figure checks to the government, not just once a year, but 4 times a year. And so in order to reduce our taxable liability, I decided to step away from the full-time operations of the clinics and start PassiveInvesting.com, which is the private equity real estate company that acquires large apartment complexes, hotels, self-storage facilities. And then even into 2022, we've moved into the express car wash space as well. And so we've had quite a trajectory since we started. So we started our group in 2018, raised $4 million that first year. In 2019, we raised $32 million. And then in 2020, even during the middle of the pandemic, we raised $61 million. And then last year in 2021, we raised $196 million from our investors. And this year in 2022, our goal is to acquire another $1 billion in assets under management, and also to raise about 350 to 450 million in equity from our investors. And this is all non-institutional money. It's all private accredited investors that we've been able to raise this money from. And right now we're sitting at the kind of the beginning of the beginning of the second quarter. So just at the end of the first quarter. And in this first quarter of the year, we've already raised over 110 million from our investors for 2022.
Holy cow. Wow. A lot to unpack there. That's incredible. So I really want to get to a lot of it, honestly, kind of the capital raising, all of that. So right now your portfolio is valued just under $1 billion. I love the specific 929 million because, we don't round up.
That's right.
But so your goal is to acquire another $1 billion on top of your current portfolio. Is that what I understand?
That's correct. Yeah. So right now our current assets under management is 929 million, but we've actually acquired just over $1 billion, about 1.2 billion as it is, but we've sold some assets as well. So our current portfolio value is just under $1 billion.
Okay. Awesome. That's incredible. Congratulations. And that's obviously awesome. And the trajectory is incredible. So let's kind of back up a little bit. First year you raised 4 million, and then that basically 10x. You said you grew 30 million the next year. So kind of talk about that progression in terms of, setting up these systems so you could go from 4 to 30, because that's a pretty huge jump in terms of, growing an investor base.
Yeah. I mean, I think a lot of it had to do with the execution from the very beginning. When in 2018, we only raised 4 million. And I always tell people that ask me, like, the hardest raise that I've ever experienced is some of my very first raises, where I actually co-GP'd with other groups first and started to actually learn the whole process of raising money. And I would raise $500,000 and, I would have 60 days to do it. And I would raise 300,000 and I would fill the gap and put 200,000 of my own money into the deal. Right. Because if I tell somebody I'm going to do something, I'm going to do it, whether it's my own money or somebody else's. So those were some of the first raises that we had that were some of the hardest ones that we've ever experienced. But being able to do those allowed me to be able to prime our investors to have them ready for our larger investments as we continue to grow and as we continue to scale. I think, one of the things that really sets our group at passiveinvesting.com apart from a lot of other groups is our level of transparency with our investors and our level of communication with our investors. And if we tell them we're going to do something, we're going to do it. Whether we have, for example, if we send out monthly updates on every asset that we have acquired and inform the investors about the performance of that asset, whether it's good or bad, we want them to be aware of that. And we want to be proactive about that communication, right? We don't want our investors to have to worry about following up with us about the performance. We're just going to go ahead and provide them with that performance on a monthly basis, provide them with quarterly financials, upload them to our portal. Our portal houses all the information, so that if they wanted to update something, they could go there and do some self-service stuff. But we also kind of strive to have a white glove treatment and I guess you could kind of call it the Chick-fil-A experience, if you will, of private equity, of making sure our investors are happy and satisfied, and we do what we say we're going to do. Because at the end of the day, we're not looking to just acquire, 1 or 2 assets. We want to be able to grow our wealth and our investors' wealth for many, many years to come. And we're usually always the number one investor in our assets, and investing, usually around 10% of our own personal into each one of the investments that we put together.
And that's so huge. And I think something that not a lot of people talk about is putting your own skin in the game. And I know that's something that the most savvy, sophisticated accredited investors really pay attention to. Is, if you're not putting skin in the game, then they're probably not even going to give you the time of day, especially if they've been in this industry long enough. So kind of talk about, the life cycle for investors for you guys. Sounds like obviously you guys are even probably beyond referrals and into, kind of using social media and other platforms. So kind of talk about, top of funnel, what that looks like for you guys. And then, the kind of the first initial contact and building that relationship and keeping it with your investors.
Sure. Yeah. So, one of the things that we always try to do is we try to if I was to preferably say this, build a fence around our herd, right? Build a fence around our investors. That's really what we're trying to do with our investor management process, and making sure our investors feel like they're more of a person to us instead of just a number, right? We want to make sure that they are not just feeling like they're just being put off to this one thing. We're taking their money and that's it. And so one of the things that we do from the very beginning is we kind of want to make sure that we can do a lot of different things to be able to create content, right? And so one of the things I like to talk about is we have our investor triad, right? And so if you can imagine a triangle, and on the top of the triangle, you write this word no, the bottom left-hand corner like, and the bottom right-hand corner trust. So there's this no, like, and trust kind of triangle. I call it the investor triad. A lot of syndicators, they focus on getting people to like them and to trust them. And one of the things they forget about is that the number one thing is actually getting people to know you. And that's really filling the top of the funnel, right? Because if you don't get people to know you, then they never have an opportunity to make an opinion as to whether or not they like or trust you. And so we need to focus on that area of getting people to know us, and then also continuing to cultivate those relationships so you can move them from the likeness phase of that triangle to the trust side of it. Because once they move over to that trust side, and sometimes and the time frame from that is different for a lot of people. Some people it could be a couple of days, a couple of hours, a couple of weeks, a couple of months. I've even had people call us, I've been following you for a couple of years now and I'm ready to invest, right? So everybody is on a different time frame and timeline there. But once they get to that trust phase, they wire you money. That's a big commitment for somebody to wire out a couple $100,000 for a deal that they're trusting you with that money to not lose it and to hopefully grow it and make a nice return off of it for their family. And so one of the things that you have to make sure you do is produce a lot of content. So one of the things that we do is we have a meetup group called the Multifamily Investor Nation. It's also a nationwide group that we provide a lot of free educational content on, called the Multifamily Investor Nation. We do weekly webinars. So every week we're doing a webinar, usually on Tuesdays around midday. And we've been doing that for, I don't know, probably 3 or 4 years now, ever since we started, and we're consistent with it. So we don't try to hold back on those webinars, try to provide as much value and give as much as we can, because we want to make sure that if we want to make sure that we're the ones that are educating people out there, and we're not charging for it. So it's all free, but we don't have to worry about holding anything back for them to, pay us to get the good stuff, right? We're not going to hold back at all. We're going to give them everything we can and provide as much value as possible, because we know the more value we provide, the more value we're going to get in return, right? And so we have our meetup groups. We have 53 meetup groups across the United States and Canada. It meets on the first Monday of every month at 6 p.m. Local time. We have co-organizers in all those different areas. We also have a YouTube channel where we post a lot of our content that we have from our weekly webinars and some of our podcasts. We have a podcast called the Multifamily Investor Nation, where we interview multifamily investors who are closing multifamily deals in the last 12 months. So instead of just getting on a bunch of gurus, which is good, right, for some things, but our particular podcast is basically interviewing people who are closing real deals in the last 12 months. And so we can do a deep dive into those deals to figure out what are they actually doing to get deals across the finish line in the current market. And then we also have once an investor reaches out to us, right? So once an investor goes to our website, they go to passiveinvesting.com. On the top right-hand corner of the website, there's a little big blue button that says join the Passive Investor Club. When they fill that form out, one of our investor relations team members will reach out to them, schedule a phone call with them, discuss their investment goals, and make sure that they are a right fit for our group, and vice versa. And on that phone call, we obtain their mailing address, because we want to be able to send them a piece of mail on a regular basis. We want to put them on our monthly newsletter list. And so we have a monthly printed up newsletter that we mail to our investors. It's a very nice, professionally designed, almost like a magazine style. It's not as thick as a magazine. It's about 16 pages, a little bit thicker cardstock, but each one of the managing partners will write an article in that newsletter so the investors can hear from each one of the managing partners. Again, that's all part of building trust and value with the investors so that the ones that have invested with us could continue to be confident with us and they'll want to refer people to us. And the people who have not invested with us yet, they'll just continue to deepen that relationship with them, and we can provide a lot of content to them through that newsletter. And in that newsletter, we also can kind of tee up new investments that we're looking at, right? So like I mentioned, we just recently launched an express car wash investment, and it filled up within 2 hours, raising $8.5 million. We had over 10 million in oversubscription. And we just recently released another express car wash that was 14.5 million. And in a few hours, it filled up as well. And we're sitting at oversubscriptions on that one. And so, but the only reason why we were able to do that is because we were able to use our newsletter to be able to prime our investors that, hey, this is an asset class that we've been looking at for the last 18 months to 2 years, and we're getting ready to launch a new investment with it. And here's why, right? So they hear about us, what we're working on before we actually release it to investors. And so it's an outlet for us to be able to continue to keep them close to us and build that fence around our investors with the top of the funnel. And then once they actually are in our actual pipeline or in our actual investor base, we want to continue to keep them as close to us as possible. Those are some of the things that we do to be able to accommodate that.
Wow, that's awesome. And what a journey. And obviously, you know, always keeping you top of mind to them, really taking care of them, focusing on the investor themselves, right? Making sure, hey, we want to make sure that we're a good fit for you, vice versa. And then one thing that, you know, is not done a lot, which I think sets you guys apart, is that physical newsletter, right? Like that means a lot when someone's actually getting something, and you know that you're paying attention. And so, and again, another thing too that you guys focus on is being able to move asset classes, right? Like not just all of a sudden, hey guys, we got in a car wash today. It's like, oh, hey, look, we've been looking at this for a while. Do you guys send out like almost like a survey, like, hey, is this something you guys would be interested in before you sort of dive deep into something? Or are you kind of at the point where you can, you have enough investors if you swap asset classes like you've done?
Yeah. Well, I wouldn't say we necessarily swapped asset classes.
Right,
We basically added on another one. Yeah. So that was one of the main reasons why we chose to use the name of the company as passiveinvesting.com and not passivemultifamilyinvesting.com or passive self-storage investing. We wanted to make sure we can leave it open for some other alternative asset classes within real estate. But what was the actual question you were asking me on this one?
So when you have your eye on other asset classes, right? So,
So you asked about the survey. So we have never surveyed our investors. I personally hate surveys myself. And so whenever I get one, I always delete it. So that's probably why I have never surveyed our investors. I wouldn't say it's a bad thing to survey your investors, but we are in such contact and have such a built a relationship with our investors that we kind of survey them and poll them, but like do it in a more personal format instead of like sending them a one of those monkey surveys, or what do they call them? I don't know what they call them. Survey monkey, the survey monkey, surveys or whatever. We don't do that. But I feel like I have a really good pulse from our investors and sharing with them. And the other thing is we're investors first. And so if we like it, we know our investors are going to like it too. With Express Car Wash, they have high cash on cash, right? It's 10% plus. We're giving investors a 10% pref on those, and the returns are upwards of 25% plus. I think those are our projections, but I think it'll go to like 30 and 35%, maybe even 40 or 50%. But being conservative, 20 to 25% plus, investors are going to like that. And so a lot of it goes down to execution. And we've run businesses before, multiple 7, 8, and 9-figure businesses, and we can do that again. And that's what we're going to do here with the Express Car Washes, which is why I think a lot of our investors jumped on that with us, because we know how to run businesses, and that's exactly what we're doing with these Express Car Washes too.
Yeah, you really nailed a great point there. I want to get to the car washes, but you really hit a great point there where you have so much experience in other businesses that allows you to kind of be nimble and move through these different asset classes where, a lot of people talk about, oh, stay in your lane, like, bread and butter, only multifamily, or maybe it's just self-storage. But because you guys have that experience that allows you to have the system in place and see everything as a business, and those systems just move from asset class and business to business. So on that car wash, is this a portfolio that you're slowly taking over, or, kind of touch on that?
Yeah. So what we're doing is we're creating mini funds within the express car wash, or within our own core express car wash portfolio, if you will. So instead of having one large, say $50 million fund that's acquiring a bunch of car washes, we're basically buying car washes in portfolio, in a large, and not a large, but in a portfolio, and raising money for those particular locations. So I'll give you a couple of examples. So we bought a 2-pack location of express car washes out of North Carolina. And we created a mini fund to acquire those 2 assets. We acquired another one, or we're acquiring another one right now. It's a 7-location portfolio right here in South Carolina. So there's 7 locations in there. We'll have one mini fund that's created to be able to acquire those 7 locations. We have actually 2 single assets, and then another 2-pack, and then another single asset that we're going to probably lump together into one to have 5 locations in one kind of mini fund, if you will. But the challenge with creating a fund with these types of assets is that these are usually smaller mom and pop operators with 1, 2, maybe 5 to 10 locations. And so it's a little bit harder to be able to know when they're going to close, because sometimes we'll work on a deal on these car wash deals for 4 or 5 months before we actually get to the point of being able to raise the capital for it, because it just takes so much time. Like we have a deal, we have a 2-pack deal actually that we've been working on for the last 3 months, and it's been awarded to us. We've been in negotiations of the PSA for 3 months, right? And so we don't know when it's going to happen, but once we get that signed PSA, the time clock starts, and then we can start moving forward with it. And so it just allows us, instead of sitting on capital or doing capital calls, to just create mini funds that investors could put their money in and diversify it across multiple locations.
Awesome. Yeah, that makes sense. Almost like a single asset fund, but obviously like the multiple locations. So, which is huge because it reduces that, kind of like you said, that capital call, sitting on capital, you kind of eliminate that and kind of get away from potentially some of the regulations that go along with that stuff as well. So that's really huge. So, obviously you guys identified in an asset class, incredible returns, makes sense why you went over there. What other asset classes are you guys in? Are you pretty much kind of all across the board, or?
So there's three asset classes that we're in right now. So multifamily is still our number 1 holdings. Then we have self-storage. We have about 100 million in self-storage right now. And then we are working on entering the hotel space. We have not acquired anything in there yet. We do have a few LOIs out and hopefully getting close on a few of those. But then we also have the express car wash asset class as well. One of the things that I would say though is that we do get questions from our investors about, do you feel like you're growing too fast and, spreading yourself too thin and putting yourself into too many asset classes? And I would say the answer to that question would be yes, if we didn't do it strategically and do it the right way. So we're not basically saying, hey, we're going to take our same team that's been acquiring multifamily and go acquire self-storage, and then take the same team that's been doing all these stuff and go acquire hotel. We're not spreading ourselves thin. We actually, as we continue to grow, we have different business units that we add on, and we hire a team to manage that business unit. So there are some divisions that are in our company that can be shared, like the back end finance and accounting and stuff like that. That's easy to share between asset classes. But when it comes to acquisitions, dispositions, asset management, there are separate team members that are built out to be able to run that particular division so that we're not spreading ourselves too thin.
Awesome. I love that. And I want to touch on that. So let's kind of get into kind of that scaling and building those teams and those systems and kind of the keys to success and the partnerships. Kind of talk about, what systems you guys have for that and how you've been able to maintain such a great partnership amongst, as you scale so quickly and, build all of that.
Yeah. So I would say that between our 3 managing partners, myself, Danny Randazzo, and Brandon Abbott, we have one of the reasons why our partnership has worked so well and it continues to do well is because we all 3 have a separate lane that we are focused in, right? We're not trying to have 3 different, or we're not trying to work on the same stuff, right? We're trying to be 3 different partners. And so if you look at a lot of partnerships that fail, over time, and if you actually dissect them, a lot of it goes back to partners that are similar, right? They like to do the same thing. And a lot of times as humans, we want to, associate ourselves with people that like to do the same things. But in business, you really can butt heads a lot when you do that. If you both like to do underwriting and you do things differently in underwriting, then you're going to always butt heads about how's the right way to do underwriting, right? Same thing with investor relations or acquisitions or dispositions or asset management. If all of you like to do the same things, then you're always going to be butting heads. And so you always want to make sure that you have complementary skill sets. And that's what each one of our managing partners has, is a complementary skill set to the other. And I can do everything that Danny's doing and Brandon's doing. I just don't like to do it. But I do know how to do it, and I can do it. But I'm really good at the investor management process, investor relations, investor services, the marketing, and kind of the overall strategic objectives of the company. And so that's where my lane is, where I strive and I thrive the most. Danny, again, on the other hand, his is all finance related, right? So he does all the financial due diligence, the financial underwriting. He heads up the asset management team. He heads up our analysts. He also works with all of our lenders and attorneys and our director of capital markets. He works on all those different pieces around finance. And then, of course, Brandon on our team, his background is in construction. So he heads up our acquisitions team, our dispositions team. He heads up the teams that are, creating the pro formas and the CapEx and, all the stuff that has to do with construction. He's doing that piece of it, right? So all three of us have a different lane that we're really good in. And yes, there is some crossover. And sometimes I have to say, Danny, stay in your lane, or it usually gets Brandon. Brandon's usually the one, Brandon, stay in your lane, right? But same thing with me. Brandon says the same thing. Hey, Dan, stay in your lane. And I know, okay, this is my lane. That's your lane. I'm going to trust you because that's what you're in that lane for. And that doesn't mean I can't give you my feedback and opinion, but at the end of the day, it's your lane. So you do with it as you will. Right. So I think that's been a very, very crucial for us in our growth and our trajectory, is having managing partners that have complementary skill sets.
Yeah, you nailed that right on the head. Really just understanding what those are first and foremost, and then, staying in your lane, which I love. So does that also mean that each one of you build your own team yourself?
We do. We have our own teams that we have built out. The way our kind of org chart is set up is that we have directors in each one of our divisions that work underneath us, and those directors are responsible for hiring their own team members. And so we give them that flexibility and that freedom to be able to do that. And as they continue to grow, if they need to make some changes to their team, then they are the ones that are responsible for doing that. But one of the things that I would say is that has allowed us to be able to grow is that in the beginning, all three managing partners were doing everything, right? We didn't have a lot of funds coming in that we can hire a bunch of people. We're sitting right now at 33, 34 full-time people that are working for us. And that's a big nugget, to shell out every month as far as salaries and bonuses and stuff like that. But for us, what we did was we said the asset management fees that we're collecting off of each one of our assets, we are not going to take that home. The goal of the asset management fee is to pour it back into our passiveinvesting.com LLC account and just allow the properties to allow us to grow, right? So the more assets we acquire, the more asset management fees we have coming in, and the more people we can hire on to support our team and to support our growth. That way our team grows with our portfolio size.
Wow. That's an incredible business model to have, because typically that's, especially in the beginning. So in the beginning, was that kind of what was paying you, keeping the lights on, that kind of thing? And that just kind of progressed into, this is how we're going to build our teams?
No. So our acquisition fees and things like that are what pay us. But we have never taken the asset management fees home. It's always gone back in. And so we basically just banked it to be able to hire more people as we continue to grow. And as we acquired more assets, those asset management fees picked up pretty quickly. And we have never had to put money into the business to support our team. It's always been off of those asset management fees.
I love that. That's incredible. When you guys first formed the team, was your goal to just grow like this? Did you really have this plan of we're just going to keep acquiring assets, or did that kind of shift over time?
No, so our goal has always been to acquire good quality cash flowing assets for our investors. One thing I will say that did change for us is that, and originally my thought was to hire a team and have them work in my office, right? To have them close to me. But when COVID hit, that changed. And it actually opened our eyes a little bit to be able to realize that, we don't really need an office. We don't really need a high-rise building and, rent out an entire floor and have a bunch of people there. And that's really unnecessary, right? And so we have a fully remote team. Nobody comes into the office and works here, except for we have one of our bookkeepers, like one of our staff accountants that comes in. He checks the mail, makes the deposits. He does that two mornings or until like the afternoon a week, and that's it. But everybody else is fully remote. They're all over the United States. We have people in California and in Colorado. We have people in Texas and South Carolina, North Carolina, Florida. So they're all over the place, and it's actually worked out really well. I think the reason why is because we have a really good, solid team that we hired on, and we pay them well enough that they want to continue to work with us. We also incentivize them so they want to continue to grow with us as well. And we're not greedy, right? We want to make sure we're taking care of our team. We want to make sure we're providing good quality benefits to our team, and we're constantly kind of monitoring that to make sure that we can provide the best for our team. And because they are a remote team, we give them unlimited PTO, which it's very hard for some groups to wrap their mind around that, but we have unlimited PTO, and we don't have anybody on our team that abuses that. And if they did, guess what? The other team members would probably, let them know, hey, you're probably taking a little bit too much time. My philosophy is as long as your work is getting done, I don't really care how much time you take off. I don't want to have to worry about babysitting you. You're an adult. You should be able to keep track of that yourself. But if you need time off, take it off. As a matter of fact, we have people right now that are working for us that love working for us so much that we have to tell them to take time off because they need some time off, right? We don't want them to get burnt out. So there is kind of a little bit of a downside to that, but most people do really well with it, and they take the time that they need, and they like that we're not sitting there babysitting them and, oh, you took an afternoon off to go to the doctor, you got to make that up, or you got to get a pay cut or whatever. It's just makes it so much easier to do it that way.
I love that. And the big takeaway there is empowering your employees. Like you said, they're adults. They know, if you have to step in, fine, maybe. But like you said, it sounds like they're pretty much managing themselves, and at that, sort of lower level where if something does seem off, it doesn't have to go all the way up to you before someone steps in and says something. But the unlimited PTO is definitely a thing that's starting to take off, especially in the tech startup world, which I was in before this. That's kind of how they get you, but that's a very different world. So it doesn't quite overlap the same.
And there's two different types of leadership, right? So there's two different sides of the pendulum. There's leadership by abdication, and then there's leadership by micromanaging, right? There's two different sides of the spectrum. And I don't think either one of those are the right way to lead, but it's somewhere in the middle. Right. And so we don't just say, hey, here's a job, go do it. But we do give them the flexibility to be able to make some decisions on their own and control their own time and do what they need to do. But then we do have, weekly regular check-ins to make sure things are being done. And our team, we all are connected via Microsoft Teams. And so we have a whole platform there that's built out that allows us to have inter-office communications. And it feels like we're in the same office as everybody, because everybody's sitting there, they're doing their work, and they're very responsive on the requests that are put out there. And so for me, it's been an eye-opening experience, but it's been also very cool to be able to have a team that, you can get much better quality people when you open up the funnel to the whole entire United States instead of just Columbia, South Carolina, which is where we're located, but to be able to open it up to say, hey, we don't really care where you live. And there's certain positions like investor relations where we want them to be strategically placed in certain parts of the country. But for the most part, we don't really care where most of our team lives, as long as they can be available to us and they get the work done that's on their plate.
I love that. That's awesome. Did you ever think when you first started out that you would be planning a year where you were going to acquire $1 billion?
I would say in the beginning, no. Our original plan was in the first 5 years to acquire $1 billion. And then when we did that in the first 3 years, we were definitely shocked, but excited at the same time. And we set our goal in December of last year for 2022 to acquire $1 billion in assets this year, knowing it was a stretch for us, because last year we only acquired about 560 million. So for this year to, almost or just under double, what we did last year and pretty much double our portfolio size was going to be a bit of a challenge. And I'm not saying it's going to be easy. I mean, it's going to be a challenge even right now. I mean, we're getting up right now. We're getting up against interest rate hikes and debt terms changing and offers are changing. So there's a lot of different moving parts there that are going to be, could potentially upset our goals. But right now, that is our goal, is to acquire $1 billion. And I'm very confident in our group in being able to do that.
I love that. So we're kind of coming up against time, but sounds like you're very bullish still, despite, the changes in the economic landscape. So that's awesome. I am as well. But I do have 5 questions that I ask all of my guests. It's the final 5. So first question, what's the best advice you've gotten from a mentor?
If you can't measure it, then you can't manage it.
Wow. Powerful. What is it about your career that makes you feel like you're fulfilling your why?
So one of the things that I like to be able to see is the impact on other people's lives. And so for us, especially in the last year, we went full cycle on 6 different deals. And it was cool to be able to see a lot of the stories of investors about how we were able to impact their lives and be able to change their lives, be able to have a large growth in their portfolio. So being able to see that, and then also getting my children involved with it, is really cool too. So I've given my children the ability to invest in our assets via me. Once they get to $1,000 of money, of cash. And so my daughter she's 11 years old. She's our oldest. She has actually invested in 2 different investments already from last year. And I pay her out on a quarterly basis, because technically she's not signing PPMs and doing all that kind of stuff. It's doing it, via me. So whenever I get paid, on a quarterly basis, I'll, pay her, her dividend. So she gets to see the growth in her own portfolio, and to be able to kind of, share that and educate other younger people to be able to learn how to do what we're doing now that I didn't realize that I could do until I was older.
Gosh, that's awesome. I love that so much. What an awesome opportunity to be able to show them. And obviously, of course you're very busy, running a large business, but I assume you also love the freedom of this as well, and being able to be present, which is so important. What's your favorite non-real estate or investment related book?
So there's a book outside of the Bible. I would say that was my number 1 book, but outside of the Bible, I would say that there is a book by the name it's called Influence: The Art of Persuasion by Robert Cialdini. And it's a book that I like to read at least once a year, sometimes twice a year. It's probably my all-time favorite book, because and if you like human social psychology, it is a phenomenal book. And a lot of the things that we do in our investor management processes is based off of some of the principles that are inside of that book.
Awesome. I love it. That's incredible. If you could have any superpower, what would it be?
If I could have any superpower, I would say if I could be in multiple places at the same time, that would be a great superpower.
Love that. That would be so huge. Awesome. And last one, what's the best way for people to get a hold of you and learn more?
Sure. So the best way to get a hold of me is to link with me on LinkedIn. You can go to linkwithdan.com, and that goes straight over to my LinkedIn profile. You can connect with me, follow me a little bit more there. If you're interested in learning some more about our group, obviously very easy to do that. Just go to passiveinvesting.com. You can connect with us there as well.
Awesome. We will link that in the show notes. Dan, thank you so much. This has been incredible.
Awesome. Thank you so much, Jonathan. I appreciate it.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.